Hello everyone. So this is Umar, and I am today here again with yet another exciting topic. So this topic is related to the cash flows. Primarily, it is what is meant by discounted cash flow. So discounted cash flow is the cash flows that or is a valuation technique that the analysts use to determine the value of a business based upon its future results. So there are a few steps that are involved in calculating the DCF, and these are five steps. So we will discuss this one. Means first you have to calculate the future free cash flows. Then we have to calculate the weighted average cost of capital. Then we have to calculate the terminal value. Then discount these cash flows based upon our VAT as of today. And then we have to calculate an implied share value. So the DCF is primarily used to calculate the business value of a company based upon its future results. And how we do that? With these five steps. Now we will discuss individual steps in a bit detail. So, what is future free cash flow? So, future free cash flows is basically a number that a business is projected to obtain in down the lane based upon its operations, based upon its profitability, and it is calculated, and it is basically a cash flow that will be available to the enterprise out of its operations, and it is calculated is by we started by the EBIT. EBIT is earning before interest and tax, and we adjust the tax impact from EBIT number. Add up the non-cash items like depreciation and amortization, and adjust the future expansions in the business. That primarily includes the CapEx, and based upon your business, the increase or decrease in net working capital is also adjusted. So this number represents the free cash flows to the enterprise. Secondly, we need to calculate the weighted average cost of capital. So what is VAT? By its name, the meaning is that the average cost of doing business, the average cost of business. In business, there are primarily two investors. The one is the sponsor that ingests the equity, and the other is the financial institution that gives the business the loan, the lines, and primarily the long-term loans. So we calculate, so we weighted average because we have two investors, one is sponsor and one is financial institution, and we weighted average both of these investors' cost of investing in the business by their proportionate share. And the third step was to calculate the terminal value. So what is terminal value? Terminal value is basically uh, total cash flows or total amount that the business will earn in its whole lifespan or in its perpetuity. Means an investor then means being the analyst primarily. Analysts build the future numbers for from 5 to 10 years normally, so you cannot build the model in perpetuity. So terminal value, and here the terminal value comes up. We calculate the number on our last projected free cash flow number, and then we draw it by a growth rate and subtract it and divide it by the difference between VAT and the terminal growth rate. So there's the terminal growth rate formula. The step number 4 and 5, the discounting and the calculation of implied share price, we will discuss it in our model. So now we are coming towards our model. So here we have built 9 years. Three are actual numbers from 22 to 24, and then we extrapolate those numbers up to financial year 30 based upon few assumptions. So these numbers are primarily hypothetical number and is used only for the understanding and for the discussion of the DCF model that we are doing. So our key assumption is that we are taking that our revenue will grow by 5% year-on-year basis. Our variable costs like materials, like maintenance, like labor is around 70% of our total cost of sales. And we are also giving an assumption that our variable cost will improve by 0.5% year-on-year basis. We are assuming the general inflation is 3%. The cash stress is 29%. These four are used for the VAT purpose that we have discussed here. That the VAT is the percentage of equity into the cost of equity plus percentage of that into the cost of that net of the tax impact. So these four numbers relate with the calculation of that. That we are assuming that our debt portion is 40%, equity portion is 60%, our cost of debt is 8%, and our cost of equity is 15%. So coming back to our model, the business has generated 12 points around 12-15% return on the last 3 years. It has an EBIT of 18.2. All these numbers in $1,000. So the business has generated the EBIT of $18 million to the tune of $30 million in the last 3 years, and we will now exploit it from here. Like we have written that the revenue will grow by 5%. So we are growing this revenue by 5% year-on-year basis. We have uh, 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 we have increased our the variable portion of our cost of sales. We have done two impacts there. We have incorporated this 0.5% in improvement in EBIT year-on-year, and then we have the growth rate. The variable cost will grow by if it's a volumetric growth, then variable cost will also grow in line with the growth in sales. So we are assuming here that our sales revenue is primarily increasing on the volumetric growth. Our admin, you build up inflation on the admin expenses, selling. We have taken it as a percentage of sales. Finance cost, we have taken it as a percentage of sales. Taxation, we have taken that our tax rate is only 9%. So we have zoomed in on a straight line basis only 9% of net before tax. And here comes our net profit. So our starting point of our free cash flow, that is EBIT. So we have calculated our EBIT here, our starting point of the valuation of any business. Uh, then we have calculated depreciation and amortization based upon last year actual plus invested capex around we have assumed that 10% our depreciation will be 10% on straight line basis. So here we have then taken two more assumptions. We have taken that we, based upon last 3 year averages, company, the business is investing 13% of its cash flows in it back to the business. So we have assumed that number same here, that the business will invest 30% of its cash flows back to the business. And the working capital, we have taken that in line, it will grow in line with the last 3 years based upon the revenue number. Coming back to our step number one, that is we have to calculate the free cash flows. So we start with EBIT. We take the EBIT number from the above. We add up depreciation and amortization. We adjust the capex and the changes in working capital. And here we are with our free cash flows for our 6 years from 25 to 30. So step number two was to calculate the weighted average cost of capital. We will discuss VAT in a separate video in detail, but here we have not calculated the cost of equity. We have given the formula of cost of equity that it is primarily the risk-free rate. We multiply with beta and then we adjust it with expected return minus risk-free rate. So we will discuss this in detail in a separate video, but here we have taken that our cost of equity is 15% and our cost of debt is 8%. We will use these absolute numbers to calculate our VAT. So based upon our debt portion of 40% at the rate of cost that is 8% and our equity portion of 60%, the cost of equity that is 15%, our weighted average is 11.3%. Our step number three was to calculate the terminal value. So here we have taken our last year free cash flow. We have growth it with our growth rate that is 2% based upon the historical company average and divide it with the difference of our VAT and terminal growth rate. So here ours now we are left with only two steps. Step number four, that we have to discount back to present value. So we have two cash flows here, free cash flow and the terminal value. We will add both of these cash flows and discount this cash flow by our VAT that we have calculated, that is 11.3% with the number of years. Like our financial year 30 cash flow is 6 years down the lane and we will discount it by 6 years to calculate our present value. So the enterprise value is the sum of these all free cash flows is the enterprise value and that comes up to $405 million. And in order to calculate the equity value, we have to subtract the debt portion from it, that is 100. So now all of our work is almost complete, and we are only at the last step. That is, we have to calculate the implied share value. We assume that our number of shares are 14,000. Based upon that, our per share value, based upon these assumptions, this model, and the VAT, is 23.25. Now we have to calculate whether the future business value the business value based upon the future is higher than its today value or not. Means if there is any upside or if there is any downside as of today value. So we assume that our trend value is 18.5, meaning we have a room of improvement based upon these projections. The company's value in today's term is 20, around 26% lower. Means an investor can potentially gain by investing on this company. So that's all for today. I hope this will help you guys a lot in understanding the basic concepts of DCF. I will also upload this template so that you can uh, so that you can calculate the understand the model more able to understand the model, and I will see you guys in another video. Thank you. Bye bye.